Hello, everyone, and welcome back to another episode of the Simple Money Guys podcast, where we make money simple for you. I'm Greg, and as always, I'll be joined by John and Ryan. Join us today as we discuss some of the most essential money tips that'll help you take full control of your financial future. If you haven't yet, please give us a follow on Instagram, Twitter, and YouTube at the Simple Money Guys, and please leave us a review on Apple and Spotify podcasts. It helps us a tremendous amount. I think today we have a couple different topics we could talk about. There was a lot of court rulings that I think would be interesting to touch on.
Yeah.
Did you guys hear about the Apple versus, I guess Fortnite was the ultimate competitor in that, but there was a ruling against Apple by the Supreme Court, and they ultimately decided that Apple cannot monopolize in-app purchases anymore. So anything that is in-app purchased can now go through a third party. And Apple used to charge 30% of whatever the in-app purchase was. So 30 cents for every dollar.
Crazy. Yeah, 30 cents for every purchase through the App Store is insane, in my opinion. I mean, literally every purchase goes through the App Store. So I just thought that was a startling fact from there. But I feel like it makes sense. Like, obviously, Apple created the App Store, so they want to like charge as much as possible. But I do think it's better to have other options. That way, people can, spend less and get more for their money.
Yeah, and I mean, it's funny because this all started with Fortnite. This is
Epic
a Fortnite
Games, yeah.
Epic Game. I think they ended up getting charged. They still got a fine of like $3 million and had to pay Apple $3 million. But to Apple, that's like pennies.
Yeah,
I'm sure Apple doesn't care about $3 million. But yeah, I mean, I guess, monopolies in general. Would you guys consider Apple only allowing people to make purchases, in-app purchases through them? And, even though it's their app store, would you consider that a monopoly and versus now third parties going to be able to handle in-app purchases?
I don't think so, because they're not even the biggest cell phone manufacturer. So
yeah, and this
Samsung the biggest, so like I wouldn't consider that a monopoly.
And it's not even necessarily just phone; it's just purchases within an app. Which, I mean, one, you have to pay money to put your app, even if it's free, on Apple's app, which is kind of funny. But
well, not really. It's real estate, right? You have access to hundreds of millions of users or tens of millions. I don't know how many users there are, but
true.
I mean, that's what it is. It's advertising, right?
Yep.
So
Yep.
I think you get what you pay for. That's why people pay for it, because it's worth it. Yeah.
but it's true. Yeah, people pay to get on the App Store, and then any in-app purchase that they make, like they could make $100,000, but 30,000 of that is going straight back to Apple. So it's like, when is crossing the line to being like they're digging too much into your profits? Like it's crazy to me how much money Apple can make off of that. Every single app on the App Store, 30% of their revenue is going to Apple. It's crazy.
Yeah, and now it's not the case anymore. So, I'm very confident that Apple will still continue to make a lot of money. Do you guys see the new iPhone announcements?
Yeah.
Oh yeah, it's nice.
I like.
They made diagonal cameras. That was like the meme. It was like, we're changing to diagonal cameras.
Yeah, we've somehow become an Apple podcast when we don't mean to be.
Yeah.
Why don't we talk about the income tax or the new tax laws?
Yeah, so that's what I also wanted to get into a little bit. Well, one, did you guys see the new stock buyback tax now?
No, dive into it.
Yeah, so on any stock buyback, which I guess, let's dive into stock buybacks in general a little bit, because we've talked about this in previous episodes and we've never really taken a true deeper dive. And essentially what a stock buyback is, for these wealthy companies that have so much cash sitting around. Microsoft is an example. They just recently approved a buyback and an increase in their dividend. But what they do with the buyback is they literally just buy back shares of their company. And by doing this, it's, what happens when more shares are purchased? There's less shares available, supply demand generally increases the price of the company. So there's been a debate, I feel like, for a long time about whether, do you guys think it's morally ethical to buy back shares of your own company to inflate prices? And, what are your guys' thoughts along those lines?
I guess it depends. Like, I think people should, or companies should be able to buy back their stocks, if they want to invest kind of more into their company. But I mean, if it goes into that like moral or ethical reasoning, it's like if they're purposely trying to, boost up their stock price, then that's almost into manipulation. I don't know how Microsoft did it, but I'm sure there's a fine line between the two.
I think where people have issues with stock buybacks is when companies do it, they don't really save any money. They don't have any retained earnings, and then when bad times happen, they just lay people off.
Yeah.
So that's where I think it's definitely in the executives, the best interest. It's never in most of the working people's best interest in general with stock buybacks, because in general executive compensation is majority stock. So when they do stock buybacks, their stock positions go much higher. So what I judge a company by is when partially, like when you look at ethical reasons, is what happens when times get a little bad. And then so if you look at the last 10 years, companies bought back so many stocks and then they just laid off a bunch of people. So it's like kind of I think that's where the ethical piece comes into it for me.
Yeah. I didn't even think about it in terms of executives just kind of increasing their pocket. But that's obviously a huge factor. The one of the unethical things I can see is only the companies with huge amounts of cash ready for deployment are able to do this. So it kind of becomes this, the rich just get richer scenario, and it's tougher for the smaller guys in the middle of the pack and everything to catch up. So the new proposed tax is a 2% tax on stock buybacks. And I think that kind of levels the playing field and makes it a little more fair.
Yeah. I mean, I think part of it could be too, maybe you're incentivized to pay your people more versus buying stocks back. And then in that case, people are willing to stay, they're willing to work harder, and then you generate more profit as a result. So that's, I kind of like that idea more versus the stock buybacks. But I mean, I'm not opposed to the idea. I think it works, but what I typically have seen is companies do it, but then kind of screw over the people when times get bad. So that's the part where I kind of have an issue with it.
Yeah, that's just corporate America, right?
It is.
John was making fun of me before for going fully corporate as he went full freelance.
No, yeah, we were saying, it was like, oh, how's your day? He's like, oh, living the dream. I was like, that is the most corporate thing to say, Just living the dream, man.
He basically said I'm just the suit now, so I appreciate that. It's okay. Ryan's still a suit right now as well with me, so we're both fully corporate.
I do. Is that a new shirt, Ryan? The Home Dime? Is that yours?
You like it?
Dude, that's sick. I love it.
I'll talk to you more about it once we at FinCon.
Yeah, dude, we gotta talk about these businesses going on.
The upcoming businesses. But Ryan, did you want to transition? Speaking about businesses, did you want to transition us into some of the new tax codes?
Yeah. So I'm gonna pull up Brennan from Budget Dog's post. He had a really good post the other day. Where he kind of just summarized the tax proposals. So it's not a bill yet, but it's been proposed. So individual income tax rates. So the top. So this would affect income earners who earn more than 400 if you're single or 450 if you're married. It would raise the highest marginal tax rate from 37 to 39.6. So 37 to 40% basically. But this only affects you if you make more than 400K single or 450 married. So most people, it's probably not going to affect. Capital gains and dividends. So it says the House bill set the target for the highest capital gains tax rate of 25%, and the previous was 20%. So it's another thing where it's probably going to affect the highest income earners as well, or highest wealth accumulators.
Yeah, so with the capital gains tax, I assume that's long-term capital gains, right?
Yes.
So basically, like if you were to, buy Tesla stock and then and long-term capital gains just means you hold it for a year or longer. Short-term would be less than a year. So if you buy Tesla stock and hold it for, 2 years and then you sell it, you have to pay taxes on those gains, however much it increased. And so originally you would pay 20%, now you're paying 25%. So again, it's not significant for, I guess, lower to middle class people, but for, the higher wealth accumulators, like Ryan said, this can affect your positions.
Yeah. But yeah, let's keep going. And I wanna talk about the Roth changes.
Yes.
Too. That's going to be an interesting one. There's some stuff about gift tax. I don't know if I want to dive into that. So, limit on large retirement plans. The bill adds one restriction prohibiting high income earners in the new 39.6% bracket from new contributions to traditional or Roth IRAs. So if you're in that income bracket, you can't contribute to your Roth IRA, but this only applies if your retirement accounts are more than 10 million. So that's another thing which affects mostly high income and wealth individuals.
I just want to stop you real quick. Wasn't there a story on Peter Thiel, how he has like 5 or 6 billion in his Roth account, and you're thinking it's like, the income limits are only 6,000 per year. It's like, how do you get 6 billion in your Roth account? And it was some convoluted way where he like purchased shares of like PayPal back when they were like pennies, and then that like boosted it up. And then I think he got into like Apple or Tesla, and he just made incredible decisions with his Roth IRA. And now he has like $6 billion tax free.
Yeah, that's crazy.
Yeah,
you can go in and out of positions.
Yes.
With a Roth without getting taxed. So I mean, he utilized the tax advantages to the fullest.
But imagine having billions of dollars of gains tax free. That's insane.
Insane. But with this new tax bill, technically he wouldn't be able to contribute more to his Roth IRA because he's got more than $10 million.
If I had billions of dollars in a Roth account, I would just even take it out now and take the penalty. I think I'm okay with paying whatever the penalty is there.
That's all the money you have. I mean,
yeah.
That's crazy.
There's another thing that increases required minimum distributions as well. This is basically whenever you turn 72, if you have a traditional pre-tax retirement account, the government says, hey, I want my money. It's been sitting in there pre-tax, cash some of it out and give me taxes. So it raises the taxes on that. And it also eliminates the backdoor Roth IRA strategy, which is a tax it's a tax loophole, which actually I it's a tax loophole that lets you do a Roth IRA if you're above the income limit. So that's a big one for sure.
That is massive, yeah.
There was really no point in having the Roth IRA income limits because of the backdoor, because you could just get around it. But now they're looking to eliminate it, which kind of sucks. And then it raises the corporate tax from 21 to 26.5 as well.
Okay. So my question always is, with new presidents, new tax codes, do you guys think in this situation, we'll bring back an old segment, news or noise? Do you think it seems like every president brings, tax changes and these drastic new laws for the people? Do you think, this is going to just stand for a couple years and then maybe a Republican president's going to come in and kind of swing the other way? What do you guys think as far as, how much this is going to have a long-term impact on our lives, our listeners' lives, everyone's?
In my opinion, if they do change like some of these laws with the tax codes and the Roth IRA, like the backdoor Roth IRA, originally you could contribute to the Roth IRA even if you had higher income limits, but now I feel like if they eliminate things like that, it'll be very tough to, kind of reverse that and re-implement it, if that makes sense. So, I do think this is newsworthy. I don't think it's just noise. I think, if they end up going through with this proposal, it is still a proposal, but if they go through with it, I don't see it being reversed when a new president comes in. That's just my opinion.
Yeah, so you took the words right out of my mouth. I think if these changes go through, then it's definitely going to be, essentially, it's very hard to make changes, you know? And I think if these go through, it's going to be here to stay for a while.
Right.
So it'll be exciting to see the progress of everything. I hope they don't get rid of the 1031 exchange. I know, John, you're probably hoping that as well. That's
Yep.
Let us keep the 1031 exchange, please.
I'm pretty sure there was another proposal, or the step-up rule, like if you inherit a property. Okay, well, yeah, and this is just a proposal as well, but it's called the step-up rule, I believe. And basically, if you, let's say your parents buy a $200,000 house, and then when they end up passing away, you inherit the $200,000 house. Well, it's been 20, 30 years, and the house that you inherited is now worth $500,000. So in the current state right now, that $200,000 would go up to a step-up basis to $500,000. So you wouldn't owe any taxes inheriting this property. But with the new proposal, it would basically say, no, that's a $200,000 house, and you got, that now it's worth $500,000. So now you owe, capital gains on that $300,000 of difference. And so they are trying to make that a rule, and I don't necessarily agree or disagree with it, but I just think it would be significant. Because, like, imagine if your parents passed down a property to you, and you're like, wow, this is great, but now you have a $10,000 tax bill. Yeah.
No, now you got to sell it.
Yeah.
Exactly.
Like, what? Now
They
you
can't
pass
afford the
anything
tax
down.
bill. They can't afford the tax bill, so now they have to sell the property. And so that's what, that is, that can be significant. Hopefully I explained that for the audience well, but it is a significant proposal.
So I'm not necessarily tax laws like that I'm against. I'm not necessarily against certain tax laws or for certain tax laws in general. Like, I'm not going to make a blanket statement here. But I just don't understand why so many changes are happening now, or the proposal is looking to happen, that soon, because, so many businesses and people are struggling right after COVID. And I don't know that this is going to help with the economic recovery.
Well, I think all these tax changes are to fund Biden. I think he has a $3.5 trillion economic relief plan in place. And whether or not it actually works out, time will tell. But obviously, he's going to need a lot of funding for that. So I think these radical tax changes and everything are here in an effort to fund his economic relief bill.
Yeah.
We shall see, though.
This is why I preach Roth accounts in general. I mean, if you look back to lots of episodes, look at 2020 episodes, why I talk about Roth accounts, the massive debt we're in, the amount of money that we keep printing. The only way that they're going to pay this is either continue printing, or, which he can't really do, that's impossible, or raise taxes. And that's what they're going to do and what they're going to continue to do. So the only way to really protect yourself is with Roth accounts. Now, if you're a high income earner, the backdoor Roth IRA is gone. But they haven't taken away the Roth 401k, Roth 403b, 457. Your employer Roth accounts, they have not taken away. So utilize that, because Roth accounts will shelter you and protect you from future taxes. Now, if somehow in the future, I doubt this would ever be the case, but could the government go back and say, hey, we're going to tax Roth accounts? Maybe.
There'd be pitchforks and fires in the street.
But they're probably the last accounts they would go and do that to. They'd probably raise taxes on everything else first.
Roth accounts, 401ks, all these retirement plans were put in place to help ease the lack of any pensions existing these days, and to secure the retirement for people. So I have trouble seeing it, but who knows at this point? There's so many changes. We talked about this before when we were recording episodes during like peak COVID. We fully expected, and we were talking about the greatness of Roth accounts then, because we knew there were going to be, I don't know if we knew this radical of changes to tax codes, but we expected higher taxes and changes to come, as did a lot of people. So, as we always do, we really see the advantage of Roth accounts, especially at times right now.
Yeah.
I was going to say, realistically, the tax law the corporate tax will probably might impact some people, but I think corporations can pay it, and they probably should, and not without making people suffer, cutting jobs, outsourcing jobs. Like, I think there should be penalties for outsourcing jobs, and corporations should pay. So I think that's something. But for the majority of these laws aren't going to impact most people. And I think what will hurt people is like the laws that you mentioned, like impacting laws like you mentioned, John, like the step-up basis, 1031 exchange, things like that de-incentivize investing. Because what's the point of saving and having get money to pass down if I can't?
Yeah, the changes even to the long-term capital gains, like.
Yeah.
As we're all investors, we're not very happy about that. But, if it's for the greater good, maybe I am okay with it.
I was going to ask, to summarize, like we say, just max out your Roth IRA, like without a doubt. Like that is a priority, to max out your Roth IRA. And then if you have a Roth 401k, I would essentially try and max that out as well. That is the tax-free money that you're going to be able to withdraw.
And take the free money that your company's giving you.
Yeah.
Take all the free money.
Greg, let me ask you, would you ever, or do you invest in individual stocks in your Roth IRA to try and get a little more appreciation? You're taking a little bet, or you could just go index funds, You could try and go the Peter Thiel way or the normal way. So
I've had a conversation with, not my financial advisor, but my wealth manager who handles one of my accounts, and she brought up this discussion where within a Roth, you could trade, quote unquote, whether it be short term or even after a year, but you can buy positions and sell positions and not have to pay taxes on them. So if I were, most of the single stocks that I pick, I'm just holding on to them for upwards of 10 years. 10 years. 5 to 10 years is my goal for most of them. If I had the intention of, maybe selling within 1 to 3 years, I would do it through a Roth, I guess. But I don't invest with that mindset. So
right.
I don't utilize the Roth in that way. And I think it's a little risky. It's a little tricky because
it is for sure.
That's your retirement money. I don't want to necessarily. I have the 5 to 10 year mindset with my brokerage account, which is going to be taxed. Now with my retirement account, I can't even fathom, possibly losing that money because, you're only capped out at $6,000 per year right now. So if you lose all that, that's $6,000 that you're not going to get back in a tax advantage account where you won't be taxed on the gains later. So, I see, who was the gentleman you said before that?
Peter Thiel.
Kudos to Peter Thiel for making billions of dollars, but I myself couldn't see it.
Yeah. I was just going to say, he invested, everything into PayPal, and it paid off. But PayPal could have easily gone under, and so he could have, not had anything. So definitely very speculative. I personally would not recommend it. I don't even do it myself, so it was just a question. So.
Yeah, the only way I could see it is if you had, other retirement strategies in place, and then your Roth account was kind of just an extra addition on top. Then, you might as well take advantage of the full retirement advantages, but I don't. That is my retirement account.
Yeah.
So I need that for retirement. So I'm going to continue just investing in S&P 500 index funds and international funds.
Good deal.
Yeah. But in summary, this episode, a lot of tax changes coming. Also, Apple, Apple is no longer allowed to monopolize their in-app purchases. But with all the tax changes coming, we fully continue to push the greatness of Roth accounts and you put taxed money into it, and then you don't worry about taxes on anything after that. As of right now, who knows if that's subject to change? But for right now, it's a great option, and one that every single person should be taking advantage of. But I think that wraps us up for this week. As always, we are the Simple Money Guys, making money simple for you. I'm Greg, also known as the Daily Investor.
My name's John, at Johnny Finance.
And I'm Ryan, the Money CEO on social. Thank you so much for joining us, and we'll see you again next episode.
Thank you everybody for listening. As always, give us a follow on Instagram at The Simple Money Guys, subscribe to us on YouTube, and be sure to tune in because we have new episodes coming every week.